Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Countdown to the crucial US jobs report as investors eye fresh clues on the Fed's policy outlook. This after a week in which traders have upped rate cut bets on softer US data. The ECB diverges from the Fed, cutting interest rates from record highs. But President Christine Lagarde leaves markets guessing on the central bank's next move.
We are not pre-committing to a particular rate path. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction.
Plus, French President Emmanuel Macron pledges to send fighter jets and military trainers to Ukraine as he and President Biden rally support for Kyiv's fight against Russian aggression. Let's check in on these markets this Friday then as the focus shifts from that ECB cut, of course, historic, the first one coming through for the cycle. Not a big surprise. Moving arguably from forward guidance from Christine Lagarde to data dependency. And we move from that story to the story around non-farm jobs, non-farm payrolls out of the US after some of the metrics on the labour market of the US have suggested that things are starting to cool. The estimates expecting a print of around 180,000. And to what extent numbers below that or above that could adjust the market pricing, as markets now have pulled forward the first cut to around November from December, September also in play. And of course, the Fed meets next week. European futures currently found a bit of holding pattern then ahead of that crucial data out of the US. In terms of the FTSE 100, you're looking at modest gains just shy of 0.2%. S&P futures looking to add just 5 points, of course, after breaking through that 25th rally record high this year. Nasdaq futures looking to add just 29 points so far as we look at this session. Let's flip the board and look cross asset then. The benchmark 10-year, interesting that it hovers around that 430 level. We'll see how much volatility there is as we lead up in and around that data print out of the US. The 10-year currently at 429, euro dollar 108. You saw a bit of strength coming through from the single currency yesterday on the back of that decision and the commentary from Christine Lagarde. Interestingly, that you had one member on the hawkish end of the spectrum who decided not to vote for that cut. Brent $80 a barrel, and you're looking at gold edging up so far in the session. Interestingly, 2,386, currently up 0.4%. Let's cross over to Singapore. Avril Hong standing by with a check on the Asian markets. Avril, what is standing out to you?
Yeah, Tom, I think it's interesting how we are keeping a really close watch on the US jobs report, but the markets in the Asia Pacific are kind of going their own direction. We're seeing Chinese equities along with those in Japan flashing red, while South Korea is playing catch up with markets there back from a holiday. Remember yesterday it was a tech-driven rally fueled by Nvidia, so we're seeing the tech stocks in the country doing quite well today. But we are also keeping a close watch on China trade data that came out earlier. Let's flip the board and take a look at some of the stock market big movers today. The drags on the Nikkei include the likes of Toyota. We have a Bloomberg scoop saying that some of the biggest banks, MUFG as well as SMFG, are set to divest, their holdings in Toyota shares to the tune of about $8.5 billion, and this would be a sign of the unwinding of those cross-shareholdings, could kind of foreshadow larger moves in that direction. Although the Bloomberg scoop did also indicate that according to sources, this move is designed in a way to sort of limit the impact on Toyota stock, because it also comes at a time when Toyota is buying back its own shares. Still, we're seeing the stock accelerating declines after it came back from the lunch break. We're seeing a bit mixed among the Japanese banks involved. Flip the board because, as I say, we're also keeping an eye on that China trade data. The exports numbers came in much better than expected. The big miss was in imports, and I think that kind of speaks to how external demand is holding up well, but you can't say the same for what's happening within China. And here it reinforces the idea of how important more policy support is, especially after last month when we saw that rescue package, there's not been very much follow through for the real estate sector since then, which is really at the heart of the issue of what we're seeing in the Chinese economy. So that's what we're seeing in China. Let's flip the board and take a look at what we're seeing in the currency space. We did get a yuan fix that was pretty steady from the PBOC today, so not much move in terms of dollar China. We are keeping an eye on the rupee. The RBI today leaving rates unchanged. There's a lot of focus on monetary policy as well, because there are some concerns about how growth-oriented policies in India might take a bit of a hit, given what we're seeing from the shock election results. Is the central bank going to help to smooth things over? Holding fairly steady on dollar rupee. The yen is the other one that we're keeping a really close watch on. It actually pairing the losses from earlier in the session where it was hovering closer to the 156 level. There are some expectations that the BOJ next week will keep rates unchanged but start priming the markets for a hike in July and potentially also announce the cut in bond purchases, Tom.
Yeah, the countdown to the next BOJ meeting. Interesting as well that you highlight what is going on in terms of domestically, the trade flows out of China, what it tells us about that domestic economy versus the global economy, particularly given that we've seen South Korean exports as well pretty strong, suggesting that maybe global demand is starting to turn around. Avril Hong in Singapore with the Asian market check. Thank you very much indeed. Let's switch back to this region then, this part of the world. The European Central Bank, of course, delivering on its promise to cut interest rates, but left investors querying where policy is headed next by also saying it will take longer for inflation to reach that 2% target.
We are not pre-committing to a particular rate path. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decision will be based on our assessment of the inflation outlook in light of the incoming economic and financial data.
OK, let's cross over to Lizzie Burden, who is on the ground for us in Frankfurt, who, of course, covered all the action from the ECB yesterday. Lizzie, what for you, then, were the key takeaways from the decision and the press conference from Christine Lagarde?
Good morning from Frankfurt, Tom. Well, if you squinted there at Christine Lagarde's necklace, I don't know if you could see, but it said "in charge." But Tom, there was a real sense of disarray yesterday, both around the decision and the rate path ahead. Look, it was a head scratcher. You had, as you say, the ECB cutting rates by a quarter point as well expected, but it was at the same time that they raised their inflation forecast for both 2024 and 2025. And you can tell the market read it hawkishly, initially at least, because of the rise in euro dollar. You also had some economists saying the ECB had talked itself into a corner by over-telegraphing that June cut. Only Robert Holtzmann of Austria, as you say, felt that he could dissent on this, and that's because of the recent economic data, sticky inflation and rapid wage growth. SocGen actually called yesterday's decision data independent. So Lagarde's response, her defence, was to say that, look, there are going to be bumps in the road. These are bumps in the road and there'll be more to come. And actually, things are moving in the right direction, hence the cut. And to be fair, the IMF came to her defence. They say that it was the appropriate thing to do.
OK, yeah, of course. I mean, look, they were telegraphing this cut from January. Now suddenly they're data dependent again. So that's hence your comments around head scratching from the ECB. Where then does it leave, Lizzie, the rate path ahead for this central bank?
Well, as you say, very much back to data dependence. Lagarde said that the ECB is not pre-committing to a particular rate path. She wouldn't confirm, in answer to Bloomberg's question at the press conference, that the ECB is in a dialling back stage, a phase. So traders are still betting that the ECB is going to cut rates again this year, but the timing's up in the air, Tom. They had thought there were going to be 2 more moves this year. Now they only see 1. And we hear, among the Governing Council, July is all but off the table. September now seen as the most likely, but I have to say confidence in that is shakier now.
OK, Lizzie Burden with all the details and the analysis on the back of that decision from the ECB. Joining us out of Frankfurt. Lizzie, thank you very much indeed. The focus now, as we've mentioned, turning to the US jobs report due out later today, of course, in the US. Bloomberg Economics expects May's data to present contradictory views of the labour market, with non-farm payrolls as well as unemployment rising together. For more, let's bring in Bloomberg's MLive strategist, Mary Nicola, with some of the details and a preview. Mary, what are markets going to be scrutinising from this print? Non-farm payrolls taking centre stage on the data front today.
Yeah, there's obviously some expectation that you can expect some softening. Of course, you don't want the data to be too soft because, of course, it triggers a sell-off across markets. So it has to be just enough to get the markets going or excited that a rate cut is coming. But the other key thing, too, to acknowledge is what is happening with earnings, and average hourly earnings will be absolutely crucial, because the other thing that could set off in a very negative way is if we see that the jobs are cooling while average hourly earnings is sticky. So that idea of stagflationary pressures coming through will weigh negatively on equities if we see that happening. So for the market, it just needs the right balance. So you need a little bit of cooling, but just not too much. And of course, you need average hourly earnings also coming off as well.
OK, just the Goldilocks jobs report is what this market is looking for.
Absolutely.
Mary, as you look back on the data that we've had so far, and of course this is kind of bookending the data story out of the US this week, particularly on the labour market, and the market interpretation of where that leads our views on the Fed and timing of cuts. Just get us up to speed on how that story has adjusted.
Yeah, of course, we've seen a lot of cooling in the labor in some of the data, whether it was ISM or some of the other data that we've seen, the JOLTS reports as well. So the expectation is obviously for the Fed could move in as early as September now, and of course again in December could be another option for the Fed, and that's on the table. So every time, this is the problem with focusing on data dependency, is that every time we get any data that comes out, you see the market swaying very aggressively in one direction. So for example, non-farm payrolls comes out to be not so Goldilocks. You see it swaying into the other direction as well, and this is going to be the problem. So the main mantra for the markets, because of data dependency, is volatility. So that means also the pricing on the Fed is going to sway with each data point that comes through.
OK, setting us up really nicely for the non-farm payrolls data out of the US, and of course the implications for this Federal Reserve. Bloomberg MLive's strategist Mary Nicola. Mary, thank you. Here's what else to be thinking about then, the day ahead today. On the economic data front as well, here in the Eurozone, at least in Germany, industrial production, that data coming out 7 a.m. UK time. Interestingly, the previous month, you saw a contraction of 0.4%. The expectations for the month of April, though, the most recent data that drops at 7 a.m. UK time, is growth, expansion in industrial production out of Germany of 0.2%. Does it build on the story that there are now green shoots in this European economy? Certainly, the ECB thinks so. They've raised their forecasts for growth, modest, but they have raised those for this year for the Eurozone. So industrial production out of Germany, 7 a.m. UK time. 11:30 a.m. UK time, we're going to get a Russia rate decision. And at 1:30 p.m. UK time, of course, the US jobs report, with the estimates landing at around 180,000. We'll see, of course, to what extent the data lines up with those estimates and how the market reacts to that. You can get, of course, a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go. Coming up, French President Emmanuel Macron pledges to send Mirage fighter jets to Ukraine as he and President Biden rally support for Kyiv in its war against Russia. And those jets could be on the ground as soon as the end of this year. Plus, we will discuss the future of European policy as 27 nations vote in those EU elections. Sophie Pornschlegel, Director of Studies and Development at the Europe Jacques Delors, joins us at 6:30 London time. Stay with us for that conversation. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Israeli Prime Minister Benjamin Netanyahu has accepted an invitation to address a joint meeting of the US House and Senate on July the 24th. It comes as Israel ups its war rhetoric against Hezbollah in Lebanon by threatening it could be forced into a war with the Iran-backed group. Meanwhile, President Biden has once again called for a pause in fighting in Gaza.
We have to get a ceasefire.
Is Benjamin Netanyahu listening to you?
I think he's listening to me. We'll see. This is a very difficult time.
Turning to the war in Ukraine now, President Emmanuel Macron says France will send fighter jets to Kyiv and train thousands of soldiers to help the country repel Russia's invasion.
We will launch a new cooperation and announce the transfer of Mirage 2005 French fighter jets that will allow Ukraine to protect its soil, its airspace, and as early as tomorrow we will start a pilot training program and transfer of planes.
OK, let's get more on this story then with Bloomberg's news director for EMEA and Africa, Ros Matteson. Ros, what has emerged then? We had the meeting between Biden, Macron, Zelensky. Some progress, it seems, in terms of European support, from the French side at least, in terms of the military of Ukraine. What are the details?
Well, that's right. So we saw the agreement. France is going to send fighter jets, but the interesting thing from Emmanuel Macron is he said they have to train the Ukrainian pilots first. He said the earliest they're going to get there is probably the end of the year. So that's telling because, for a start, that means that he thinks the war is still going to be going on potentially at the end of the year, but also they're not going to arrive immediately. And as we know, there's a crunch point going on now for Ukraine where they're running very short still on weapons, including fighter jets, and repelling these fresh Russian advances near the border. And in fact, France is among those countries that is now allowing Ukraine to use Western-made weapons to make targeted strikes inside Russia. So we had the announcement about that in terms of fighter jets, but we still are waiting to see the bulk of this fresh aid arriving into Ukraine. And certainly the signs are that it's going to take many months to get there.
Yeah, and Macron asked as well whether or not that would be seen, at least the training of soldiers in the western parts of Ukraine, as a sign of aggression. He says no, that shouldn't be interpreted as that. When it comes to the next meetings then, because there's further meetings between Biden and Zelensky at the G7, what can we expect from that? Is anything material in terms of what moves the dial, as you say, for a Ukraine military that is challenged right now?
What will be there probably is more the conversation around money. So this is actually also keeping the lights on in Ukraine, the economy going, and that's around what to do with all these Russian assets that have been seized since the start of the war. We're talking hundreds of billions of dollars of Russian assets that are sitting in central banks and elsewhere around the world. And that's been a very difficult and tricky one too. Do you use those assets? In the meantime, how do you put them to work? And we're edging towards, and possibly will come up again at the G7, the leaders will talk about it, is can you use the interest from those assets to loan money to Ukraine now? So you send them money now, they're funded by the interest from these assets, but at some point, of course, that means that those assets have to stay available and not under sanctions. So it's a little bit tricky, but that's probably what's going to be up for conversation at the G7 specifically.
OK, so two components. There's the financial part coming through on the G7 and then the military support coming through, at least from France, as Europe continues to build out that response. Bloomberg News Director for EMEA, Ros Matteson, with the context. Ros, thank you very much indeed, as always, with the analysis. Coming up, hydrogen is a key part of the EU's plans to reach its climate goals. We're going to ask if the bloc is doing enough to hit those targets on climate. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the EU sees hydrogen as key to reaching its climate goals and reducing reliance on imported fossil fuels. Germany recently announcing it will fast-track permits for hydrogen projects. But is the bloc doing enough to reach its targets? And those targets are pretty ambitious. I'm joined now by Adi Bashiam from Bloomberg NEF's hydrogen team for some deep dive analysis on this story. So, Adi, thanks for joining us. The EU has set itself some pretty aggressive targets in terms of hydrogen, so wanting to produce about, 10 million tonnes of renewable hydrogen by 2030. What is your assessment, your and the team's assessment, as to whether or not that is going to be hit, how realistic that is?
Yeah, in our latest outlook, we see most markets missing their targets for 2030 for hydrogen supply. So in our outlook, we see about 16 million metric tons of hydrogen production coming online from low-carbon sources by 2030. That's about half of what most governments want to produce by 2030, 34 million tons or so. For the EU itself, we think it will miss its target by 3/4, just producing 2.5 million tons instead of...
That's a big miss.
Yeah, that's a big miss, mainly because policy implementation has been slower than we all expected.
OK, so it's a slowdown in policy implementation, so that's where we're looking in terms of some of the roadblocks. The momentum, as you look across the Eurozone, where do you see the momentum coming through on this story?
Yeah, absolutely. I mean, Germany, Iberia, some of the locations where hydrogen will be cheap to make, but also where there's a lot of subsidies encouraging the uptake of low-carbon hydrogen. That's where we see most of the momentum behind this.
And on the topic of blue hydrogen, unpack what that is and what the potential is around that, and how you think about kind of splitting blue hydrogen from green hydrogen and how that story evolves.
Yeah, blue hydrogen is another way of making hydrogen low carbon. It's basically producing hydrogen from natural gas, the way it is produced already today, and then adding carbon capture and storage to it to remove the carbon emissions from it. It's the more conventional way of doing it. It's easier for a lot of producers today because it's already the existing process plus carbon capture and storage. And it is cheaper today than green hydrogen. The challenge is that you'll never get to zero emissions with blue hydrogen because there's always a residual emission with the natural gas that you have. In our outlook, we see about 60% of the supply this decade coming from green hydrogen using electrolysis and renewables, and the remainder 40% coming from blue hydrogen, particularly in the US, where you have cheap natural gas and tax credits incentivizing it. OK, so a 60-40 split is what's forecast. Andy, thank you very much indeed. Really interesting in terms of where the EU is on this and the catch-up that's needed to get to those targets. With the deep dive analysis there on what is happening in the green hydrogen space and the EU's role. Adi Bashiam from Bloomberg NEF's hydrogen team. Thank you. If you would like to hear more from BNEF's analysis and team of analysts, download the Switched On podcast on Apple, Spotify, or wherever you get your products. Staying with the renewable shift, a really interesting story evolving around CATL. This is one of the key suppliers. It is the biggest maker of electric vehicle batteries. The stock taking a big hit in the Shenzhen session on mainland China today. As you can see, down close to 6.5% on calls by some lawmakers in the US to have imports of their products banned into the US. Early days in terms of this story, but of course the impact is being seen there on the stock for CATL. And a reminder that the companies based in China, many of them involved in the renewable space, remain vulnerable to these geopolitical tensions. And again, we look ahead to the elections in November and the prospects of a President Trump who has suggested he would put in place more tariffs on Chinese goods into the US market. And of course, Biden has not unwound the original Trump tariffs as well. So the politics, the geopolitics, and one name in particular taking a big hit. And this is a company that is and does play a monumental role in terms of the supply of electric vehicle batteries globally. So we continue to watch the fortunes of CATL and the broader implications. Coming up, elections are underway for the European Parliament, a vote that will help set the policy direction of the EU for the next 5 years. Yes, the transition around climate change and those goals is part of the discussion, as is, of course, the need to build out Europe's own defence capacity. We will have analysis live from Brussels. That is next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. Happy Friday. I'm Tom McKenzie in London. These are the stories that set your agenda. Countdown to the crucial US jobs report as investors eye fresh clues on the Fed's policy outlook. This after a week in which traders have upped rate cut bets on softer US data. The ECB diverges from the Fed, cutting interest rates from record highs. But President Christine Lagarde leaves markets guessing on the central bank's next move.
We are not pre-committing to a particular rate path. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction.
Plus, French President Emmanuel Macron pledges to send fighter jets and military trainers to Ukraine as he and President Biden rally support for Kyiv's fight against Russian aggression. Let's check in on these markets for you then. On a day when arguably many investors will be sitting on the sidelines, or at least not taking any big bets until the data comes through on the non-farm payrolls print. The jobs data out of the US was estimates of 180,000 in terms of non-farm payrolls for the most recent month, with unemployment sitting at around 3.9%. But of course, if those numbers come in above or significantly below those estimates, then you could see some volatility, particularly across the Treasury curve. Markets pulling forward their bets on the Fed cuts from December to November so far this week on slightly cooling, slightly softer labour market data. Whether this builds on that picture and leads to further adjustment, pulls September further in, is a key question for these markets. European futures currently flat then. FTSE 100 futures looking to add just 11 points. S&P currently looking to gain 0.1%, of course, after notching a 25th record high this week. Nasdaq futures at 19,000, looking to add 0.2%. Let's flip the board and look cross-asset. 430 or thereabouts on the US 10-year. That's where you are. Not a lot of movement. Yields up just 1 basis points. Yields move a little lower yesterday. The 430 mark seems to be the holding line, at least for now, until the data comes out in the US around the benchmark 10-year. Euro dollar 108. You did see a bit of strength for the single currency yesterday on the back of the decision from the ECB, but more importantly, the commentary that they will be data dependent, not flagging the inevitable or the inevitability of further cuts coming through in terms of the cycle. $80 a barrel on Brent, up 0.2% on oil. And gold seeing a bit of upside as well, up 0.3%. Let's get to some breaking news out of TSMC, of course, the chips manufacturer with a significant and primary footprint, of course, over in Taiwan, coming in with sales, as you can see, in Taiwanese dollars of 229 billion. We got some news as well out yesterday from TSMC in terms of an upgrade and a buyback story. The details on this then, May sales of 229 billion Taiwanese dollars versus what we saw this time last year, 176. So, of course, significant growth there in terms of the sales year on year for the month of May from TSMC, of course, this essential manufacturer of chips, and benefiting largely from that demand around AI accelerators, the kind of chips built by and designed by the likes of NVIDIA. Let's get back to the politics, though, because elections are underway to the European Parliament, a vote that will help, of course, set the policy direction of the EU for the next 5 years. After the Netherlands yesterday, Ireland and the Czech Republic are voting today, with the remainder of the 27 nations polling over the weekend. For more, let's cross over to Bloomberg's Stephen Carroll, who's on the ground for us in Brussels. Stephen.
Tom, good morning. The political landscape of the European Union is going to shift in the next couple of days as voters pick who's going to represent them in the European Parliament. Those MEPs will then have to go on to tackle some of the major policy issues facing the 27 countries that make up this union, whether it be security challenges after the war in Ukraine, or competitiveness, or even trade tensions with China as well. To get a better understanding of how these elections are going to impact the policy going forward, I'm joined here in our Brussels studio by Sophie Pornschlegel, who's Director of Studies and Development at the think tank Europe, Jacques Delors. Thank you very much for being with us this morning, Sophie. 27 countries going to the polls. Can we really talk about common issues in this European election, or is it 27 countries voting on national issues?
First of all, good morning and thanks for the invitation. It's true that you don't have a European public sphere, so that really means that you have 27 member states voting separately on different agenda issues. Overall, though, you can see that there are some European tendencies where really, for instance, cost of living played a big role. You know, also climate's not going away. So there are some common tendencies. And based on that, the European Commission and, of course, you know, with the political guidelines, the Council and the European Parliament will decide upon the next priorities for the next mandate.
There's a lot of focus about how particularly hard-right and far-right parties are going to perform in this election. If their representation were to increase, What does that mean for policy making in the European Union? What does a differently composed parliament mean for some of those really big challenges?
Yes, so I wouldn't be too alarmist. I mean, looking at polls, you will have a slight share increase of far-right parties. I think what it will affect mostly is, of course, how centre parties will react to that change. And I think it's very interesting to see what kind of alliances they're looking for, especially the European People's Party, which are the Conservatives in the parliament, deciding whether they want to have like a bigger coalition with the Social Democrats or whether they're looking to the right. For instance, the European Conservatives and Reformists, so Meloni's party also in Italy, which are neo-fascist. So it might have like a slight policy change, but that's up to the Conservatives really. Overall, I would say that we will have a bigger share of the far right, but it's not to the point where they will decide completely upon the next EU agenda.
Yeah, of course, Giorgia Meloni's party would describe themselves differently to that, but I wonder on policy areas like the Green Deal, for example. 5 years ago, all we were talking about was climate policies in these elections as well. Is the Green Deal in danger now?
Well, I hope not, because it would be quite erratic policy making, and that's pretty bad also for businesses who already did the investments. So I think that policymakers are aware of this, but it's true that we are in a completely changed political environment. 5 years ago, we didn't have the COVID-19 pandemic, we didn't have the Russian aggression war. So there are some, crises coming up, which made that other priorities are now more important, such as defense, competitiveness, rule of law and democracy also being part of the leaked strategic agenda. Maybe that's also important to understand that the European elections are important for the European Parliament, but they really define also the priorities. So they define the top jobs coming up and also, whatever the Council is going to do. And if you look at the priorities there, I think the Green Deal is not completely going away because there's still quite a lot of enforcement and compliance which is required from the initiatives that have been taken. The question is how much new initiatives will be taken, and especially on issues such as the Carbon Border Adjustment Mechanism, CBAM, which also affects a lot of import-exports into the single market. There's still a transition period, so I think it's not completely done yet, I would say. It might not be at the top of the decision-making priorities overall, but in the background it will definitely continue to be a topic.
Sophie, you're an expert in the Franco-German relationship as well, and I'm interested in how you feel under Olaf Scholz and Emmanuel Macron. How is that shaping the dynamic in Europe? Because, of course, the leaders have a very important role to play after the European elections as well when it comes to selecting the Commission President.
So we all know that at the highest level in the governments in France and Germany, they didn't necessarily have the best relationship, unfortunately, but it seems to be shifting slightly since Macron did his second Sorbonne speech, where he really laid out basically his European program and also his expectations for the next Commission. And Scholz, you had a few state visits where they seem to now have a bit more of an understanding that they really need to invest in competitiveness, investments, and also make sure that we have a good industrial base in Europe, because that's really, what they're looking at they see.
OK, Sophie Pornschlegel, great to have you with us in studio this morning to discuss some of those issues in those European elections. Sophie Pornschlegel there from the think tank Europe, Jacques Delors. Tom, back to you in London.
Bloomberg's Stephen Carroll on the ground in Brussels. Really fascinating conversation. Stephen, thank you very much indeed. And Stephen will continue the coverage, of course, of those elections for us over the next few days. Stephen, thank you. To the ECB now, and that decision, of course, historic. Not a big surprise, but nonetheless historic. The first cut, of course, of the cycle. Promising, though, not to give us further clarity in terms of where they go next. At least that uncertainty remains. They came through with that quarter-point reduction, of course, yesterday, as expected. But leaving investors guessing, then, on where policy is headed next. Let's bring in NLive strategist Ven Ram for the analysis on this. Ven, where do we go from here then with the ECB? What is your take on ultimately where the likely terminal rate lands for the Central Bank of Europe?
Morning, Tom. As you said, it's pretty much a guessing game. Lagarde did very little away. She's playing her cards close to her chest. Now, but there is a lot more information that we can glean from the macroeconomic revisions that the ECB came up with. What did they do there? They revised up the growth forecast, and they revised it up pretty impressively. I mean, they went from 0.6% growth to 9% growth. That would argue for higher rates. And then what did they do with inflation? They think that inflation is going to be 2.5% this year, not 2.2% that they were thinking earlier. And for 2025, they revised up the inflation forecast to 2.2 percentage points. That means that they are admitting and conceding that they are not going to be able to meet the inflation target until at least 2026. So if you put all that together, Tom, what do you get? Is that, the interest rates are going to be higher than investors expect. The ECB earlier this year released an economic research module that showed that their neutral rate in the Eurozone is about 50 basis points, a real neutral rate of 50 basis points. And if you assume that it's going to be 2.2% next, which is their own best case scenario, mind you, that means that the lowest rate that the ECB could get to is 270 or 275, because they move in 25 basis point increments, obviously. So that's 275, which means there's room for just 4 rate cuts from here. So the markets seem to be thinking we'll get 2 of those in the remainder of this year alone, which I think is a mistake.
OK, Ven Ram, on the neutral rate, the implications that maybe the ECB can only ultimately get down to around 2.7, 2.75%. Ven Ram with the analysis. Thank you. We're going to have to cut it short a bit, Ven. We have some audio issues, but we appreciate the insights, of course, and some clarity coming through in terms of the next steps, potential next steps, of course, for this ECB. Now to some other news making, of course, some waves today, this Friday. A US jury has found British tech tycoon Mike Lynch not guilty of criminal charges that he pulled off Silicon Valley's biggest ever fraud 13 years ago. Lynch was accused of duping Hewlett-Packard into buying his software startup for $11 billion. Lynch's victory in San Francisco federal court came after he lost a civil trial in London in 2022 over allegations he and Autonomy's former finance chief used accounting tricks to inflate the company's revenue ahead of its sale back in 2011. Again, he has been given a pass, of course, and the courts in San Francisco deciding that he is not guilty of those charges in that jurisdiction. Now, data from property portal Zoopla shows tenants in the UK got a small respite from spiralling rents in April, with competition for properties slipping from the fiercest levels in years. Annual inflation for new lets eased to 6.6%, the lowest growth since October of 2021, and down from 10% a year ago. Some of this due to the cost of mortgages ticking lower, enticing more renters into buying properties and in turn lowering demand for tenancies. Coming up, oil giant Saudi Aramco set to raise at least $11.2 billion in its share sale. We break down the numbers and what it could mean for the Saudi government's ambitious investment plans. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. We have some lines crossing from one of the ECB members, of course, on the back of that decision by the European Central Bank to cut interest rates as expected yesterday, but not giving any clear guidance on next steps of the European Central Bank. So Kazaks, the Latvian Central Bank governor, of course, a member of the board of the ECB, saying that any further rate cuts should be gradual. Next steps are data dependent, meeting by meeting, echoing, of course, what we heard from Christine Lagarde yesterday. Also saying that the victory over inflation not yet on hand. That also mirrors what we heard from Christine Lagarde, who also suggested, of course, that there has been significant progress, but they cannot yet claim victory. So some lines crossing there from one of these ECB officials. Now, Bloomberg understands that Saudi Arabia is planning to price its Aramco offering at 27.25 rials, putting it on track to raise at least $11.2 billion US. Joining me now is Bloomberg Horizons anchor Jumana Pasechi, who's been following this story for us from the outset. Joining us out of Dubai. Jumana, what's the latest then on this deal?
Yeah, well, Tom, we've obviously been tracking it very closely throughout the course of the week. And you know that books were launched on Sunday to very strong initial demand. A lot of that came from the local investment community. And the book building process has continued throughout the course of the week, obviously opening up to some of that international and foreigner demand. We found out yesterday that the deal is looking to get priced at 27.25 rials per share. They're selling 1.55 billion shares. So in total, they would raise around $11.2 billion, ballpark close to where they were looking to initially raise about $12 billion. And key this time around is how much interest this deal would have generated from the international community. Now, back in 2019, remember when that IPO launched in December 2019, there were a few questions about the ultimate market capitalization of Aramco and questions about future cash flows. This time around, it looks as though the deal, and from what our sources tell us, has actually garnered a lot of international interest. We don't know the full allocation yet, but from what we gather, investors have been drawn to Aramco's high dividend. And this has been a consistent policy out of Aramco the last few years. The dividend yield is attractive, and they're committed to providing that dividend, even if it means borrowing on the market. In addition to the fact that this time around there seems to be a lot of demand coming through from Asia, from clients in India and China, which also underscores some of the recent developments in the geopolitical leaning of Saudi Arabia towards the east as well.
So the dividends pulling in those international buyers, creating some opportunity there. Jemana, look, as you well know, this is it's a corporate story, but it's also a national story, a story around Saudi Arabia's funding ambitions. How does it tie into that? How does it position Saudi Arabia in terms of meeting some of those goals and targets?
Yes, absolutely. I think the funding aspect is key here. I mean, Aramco's number one product obviously is still oil, but even the company itself is looking to make a transition from upstream to downstream company. Saudi Arabia have so far sold only about 2% of the company, so there's still a lot more that they can sell to generate more funding for the state. But this is part and parcel, of course, of the Saudi 2030 vision, a diversification of the Saudi Arabian economy away from being so hydrocarbon reliant and branching out into other sectors, things like tourism, hospitality, healthcare. And to do that requires a lot of spending outlays. For this year alone, they're estimated to have a $21 billion fiscal shortfall. So how do they meet that? In addition to selling down their stake in Aramco, we've also seen plenty of bond issuance this year out of Saudi Arabia, be it at the sovereign level, Sukuk, and even last week, Tom, they issued a bond in sterling directed at some of those sterling bond investors as well. So it tells you that they really are ramping up funding in light of where oil is trading, sitting at around $80. IMF estimate that the break-even level is $100, hence why we will see more issuance out of Saudi Arabia.
OK, that's really fascinating, isn't it? OK, on the corporate story, Saudi Aramco and, of course, the share issuance and what it means more broadly for the economy of that country. Bloomberg Horizons anchor Jemana Pasenshi in Dubai with all the latest. Thank you. Now to South Africa, where leaders of the ANC have met to discuss how it will work with its rivals after last month's election failed to produce an outright winner.
As the ANC, with its 40% return of votes, cannot really set up government without cooperating with others. We will not preclude the possibility of working with any party so long as it is in the public interest and it is in keeping with the principles that they have articulated.
OK, let's get more on this evolving story then, bringing Bloomberg's Jennifer Dabasaja on the ground for us in Joburg. Jen, ultimately then, top-line question, what kind of coalition is South Africa looking at right now?
Right, Tom, as one of our reporters put it earlier today, the ANC has really put the ball back in the opposition party's court because they have said, and we just heard from President Ramaphosa there, they are committed to working with any of the parties that are committed to shared values, nation building, and also social cohesion. The question is, though, what are those parties? And this honestly ultimately gets the ANC potentially away from having to form a coalition, an exclusive coalition, potentially polarizing voters. The question, though, is which parties will come on board. We've heard from some of the parties saying, and namely the DA, we heard them earlier this week saying they would not work with the left-leaning parties like the EFF and the MK. So the question now is who is going to ultimately come together and how are they going to form a government?
What have we been hearing from Jacob Zuma, former president, of course, whose own party, relatively new, caused such a kind of ripple effect, such a shock in this election?
Right. It was the wild card of this election, Tom.
Yeah.
Listen, we did hear from the ANC saying that they have tried to engage with the MK party because, of course, as you just saw on this graphic, it is now the third biggest party here in South Africa, but they haven't been able to get much response yet. And the people who they have spoken to say that they're waiting for some direction from former President Jacob Zuma. But we did hear from the MK party posting on X that the expectation is that there will be engagements with the ANC soon, but their priority is to prioritize the inspirations and aspirations of the South African majority and blacks in particular. So the question now will be, what will those engagements look like? What sort of demands potentially will the MK party be asking for? And again, the ANC has said pretty clearly that one of the MK's top demands, having Cyril Ramaphosa resign, is not something that they are going to consider. So it's going to be very interesting to see really how these develop going forward.
OK, Jen Zambasaja on the ground for us in Joburg. Plenty more coming up. Stay with us. This is Bloomberg. Welcome back. Happy Friday. Yes, it is non-farm payrolls day. And as we look ahead to estimates of 180,000 with jobless rate at 3.9%, those are the estimates. The data, of course, dropping later today in the US. Just reflect on this. The latest data coming out of the Bureau of Labor Statistics in the US suggesting that previous numbers around non-farm payrolls may need to be revised down by as much as 60,000. That coming from the quarterly census employment and wages figure. And those are used to readjust the non-farm payrolls data on an annual basis. So it suggests that this is a cooler labour market than maybe some had expected. We've had data out this week, of course, in terms of ADPs, in terms of claims. And that suggests, again, and builds on the picture that maybe this is a cooling labour market in the US and maybe it has further to run. Again, the non-farm payrolls data out later today, 180,000 is the estimates. But just bear in mind what we're hearing from the Bureau of Labour Statistics on the potential revisions of up to 60,000 per month for this data. Let's flip the board and switch focus to a very different story, because once again, the meme stock story is back in focus for us yesterday, with GameStop rallying on the news, it seems, and expectations that Roaring Kitty, Keith Gill, is going to be back with his YouTube live stream, 7 p.m. it seems, or 12 p.m. I should say, US time, on June the 7th, today, later today, after hours. This is a move in GameStop. Worth reflecting on his options holdings, by the way. Just in context of this, let's flip the board. It does seem, we haven't verified it, but he did show a screen grab of this, that he has about 120,000 options at $20. We're at $27 right now, so he's sitting pretty as things stand. But it looks like he may have loaded up on those options in around and towards the middle of May. So just bear that in mind as we look ahead to that YouTube live from Roaring Kitty. The meme stock story back in focus. Up next, it is Markets Today. This is Bloomberg.